Hello, I'm David Waddell, CEO and Chief Investment Strategist for Waddell & Associates. Thank you for clicking into this very timely economic and market update. I say timely because at the moment, political, economic, and market anxieties reside near all-time highs. And given the fact that those of you who are watching are all excellent students, I suspect you have noticed and might appreciate our perspectives. In evaluating this market's influences and potential direction, federal governments and central banks worldwide have been playing an outsized role lately, pushing our markets and economy up at times, and then switching direction and pulling our markets and economy down at times. Their ever-changing and conflicting policies have created volatility for market participants, making forecasting overall market direction very difficult. In searching for a visual to describe the tension inherent within today's markets, I recalled Dr. Doolittle's fabulous beast, the push me, pull you. Of all of Dr. Doolittle's exotic creatures, none got more attention than the push me, pull you. The push me, pull you had two heads and no tail, making it impossible to sneak up on, and given its conflicted nature, making its direction nearly impossible to predict. For our purposes, I have reimagined the push me, pull you as half bull and half bear. Unfortunately, the masters of this strange beast are the global monetary and fiscal authorities. In my head, the bull represents the upward push of policy stimulus, while the bear represents the downward pull of policy constraints. But before we climb astride this mythical beast, we must determine which way to face. But to know where something is going, we must know where it has been. As you recall, at the end of the global financial crisis, the central banks around the world dropped interest rates down to nearly zero and printed a whole bunch of money to try and stimulate the economy. Over the 8-year period between 2007 and 2015, the bull definitely had the upper hand on the bear. So to push us up, what I'm showing here is the policy rates of the U.S. Central Bank, the Federal Reserve, the European Central Bank, and also the Bank of Japan. Other than one misguided rate hike from the European Central Bank in 2011, you can see that central banks around the planet kept interest rates basically at zero in an attempt to stimulate the economy. Well, while they kept rates at zero, they also printed a whole lot of money to buy securities to try and help elevate asset prices. So in this chart I'm showing we went from about 3 trillion of assets in central banks around the planet, in the major three, up to about 11 trillion by the end of the period. That was a lot of money printed, a lot of asset purchases, and it ended up adding a significant amount of stimulus to help the economy recover after the great financial crisis. Global GDP bottomed out in 2009, and you can see regained some strength thanks to these bullish policies to get back to about a 3% run rate all the way through 2015. And in the U.S., we actually topped out before the financial crisis at a total amount of household net worth around $70 trillion. You can see we fell down to 56 trillion. I remember that period. I know the clients remember that period. It was a difficult period in housing and in stocks and in any kind of securities. But thanks to the Fed's efforts, we were able to rebuild our balance sheets. And in fact, we overcame that $70 trillion mark back in 2012 and continued higher to where at the end of 2015, the U.S. households accounted for about $90 trillion in net worth. So very successful. Thank you, Mr. Bull. But the bear became very jealous during this period of great prosperity and decided maybe we were getting ahead of ourselves and we needed to pull some of this stimulus out of the marketplace. So between 2015 and 2017, there was a shift, specifically a shift in Fed policy. Again, we had the zero interest rates all the way through 2015. And then at the time, Janet Yellen decided we really don't need emergency support for these markets anymore. So let's go ahead and start raising interest rates just to signal all clear to the global markets. And so they raised rates once at the end of 2015, and they raised rates again at the end of 2016. Well, not only were they raising rates, but they extinguished their asset purchase program known as quantitative easing. And so this is the U.S. Fed balance sheet, and you can see that we grew pre-crisis from about $900 billion worth of securities in their pockets up to $4.5 trillion worth of securities, again, all bought with printed money. Very, very, very impactful stimulus. Well, in 2015, when they decided to raise rates, they also decided to stop buying securities. They reinvested those that matured, and that's why this line has gone flat. Nonetheless, that ended up being somewhat bearish, I think, for the economy and also for the markets. And you can see U.S. GDP off of the low in 2009 started growing 2.5%, 3%. It had picked up a good amount of steam. That's what made the Fed feel like they needed to intervene with these bearish policies. And as soon as they deployed them, notice that the growth rate went from 3%, which is our historic average, down to 2%, which made voters somewhat concerned. Furthermore, these same voters experienced a drawdown in the sort of returns they were receiving from equity markets. This is a chart of the stock market year over year using a very broad index known as the Wilshire 5000. And what it shows you is we were printing 10%, 20%, 15% kind of rates of return up until the Fed decided to backtrack on some of its stimulus policies. Next thing you know, we had a pretty flat period, 2015, 2016, in advance of an election. So the U.S. voter decided, and again, I'm catering to the U.S. given the fact that we are the largest economy on the planet, but the U.S. voter decided that maybe we needed a change because we didn't really want to accept the fact that the U.S. economy could only grow at 2%. And we didn't really want to accept that stock markets had given us all the gains for the cycle. And so in walks this guy. This is Donald Trump. He became the president at the end of 2016. And at the end of 2017, he passed the much anticipated Tax Cuts and Jobs Act, which dropped the corporate tax rate down a significant amount from 35% to 21% in an attempt to stimulate the economy, get us back to 3% growth, and pull the stock markets back towards all-time highs. So how do you do? Well, it was very bullish. In fact, the total value of the stimulus was not just what you see as $200 billion in terms of tax cuts, but at the same time, he was also spending $100 billion on really more military equipment. And then there was a $700 billion repatriation of corporate cash that was held overseas that came back onshore, went to work. So in total, the fiscal stimulus in 2018 really amounted to $1 trillion. Given the fact that our economy is $20 trillion, that sort of injection will certainly goose growth, which it did, fulfilling his campaign promise, at least on this one. We went from a 2% growth rate to up to a 3.5% growth rate. And so clearly it was effective in terms of GDP and also in terms of unemployment, and now we're seeing wages rise. So the fiscal impact was very bullish for the economy and also very bullish for the market. So corporate profits, because of that tax cut, went through the roof, and following close behind and somewhat in advance were stock prices. So this is that same Wilshire 5000 stock market index, trailing 12-month returns, and you can see we got back into the huge gains that we'd gotten used to prior to the bearish influence of the Fed. Oh, but then again, the bear gets a little bit jealous because the bull's having its way again, and so we need some policies that will, again, pull the market and the economy down to ensure that everything stays within balance. And so we saw a good deal of monetary restraint in 2018, 2019, which I think to a large extent is responsible for the volatility that we're seeing today. Now, the Fed has two jobs. Congress gave them two jobs. The first job is to maximize the employment levels across the U.S. economy. This chart here shows you the unemployment rate in the United States of America, and as you can see, the unemployment rate below 4% is lower than it's been since about 1969. So if you're a member of the Fed, you can pat yourself on the back. Congratulations, we now have the lowest unemployment rate we've had since the late 60s. We have fulfilled this mandate. Check that box. The second job of the U.S. Fed is to maintain price stability. Now, the U.S. Fed has decided that price stability means an inflation rate of 2%. Well, as the Trump tax cuts went into effect and started influencing a higher GDP rate in the economy and also goosing the stock markets, we did see a leg higher in inflation all the way back to the Fed's 2% target. So again, if you're at the Fed, you're patting yourself on the back and you're saying, job well done. Not only do we have full employment, but we've reached our inflation objective. The risk now, of course, is that we blow through that inflation objective and we have to correct things on the other side. So let's just be preemptive. And so they were. You can see in 2017 and then certainly in 2018, the Fed got very aggressive with the federal funds rate and started raising rates 25 basis points at every single meeting, seemingly on autopilot. But at the same time, they were also shrinking their balance sheet. Now, curiously, the Fed said they didn't think that quantitative tightening, the selling of securities on their balance sheet, draining liquidity out of the market, would have much influence, while at the same time applauding themselves for doing quantitative easing to get us out of the great financial crisis. And so there was a little bit of a conflict in there, consistent with the push me, pull you theme, where they said quantitative easing good, quantitative tightening doesn't matter. Well, in terms of quantitative tightening, I think it did matter. They started selling $50 billion a month off of their balance sheet while raising interest rates. For those of you who read our Friday newsletter, and I'm sure it's all of you, you may recall back in September of last year, we begged and pleaded with the Fed, who clearly doesn't read our Friday email, not to raise rates anymore. Well, you can see in this chart, they weren't listening. And in September and December, they raised rates twice and immediately had an influence on what you can see here. The 10-year break-even inflation rate started to decline right after those two rate cuts. And so inflation expectations were coming down, indicating maybe the rate cuts or the rate hikes were overdone. My personal index of preference and choice right now is the leading economic index to get a sense of where things are going, and we're going to drill into that in a minute. But you can see, concurrent with the rate hike in September and then the one in December, they crushed the leading economic index. Pretty dramatic decline, also signaling that the rate increases were overdone. And then lastly, if you've got falling inflation expectations and you've got falling economic expectations, you can bet your bottom dollar that you're going to see a fall in long-term interest rates. And we did see that. The 10-year rate fell from above 3% to, at least in this time period, down towards 2%, and it's fallen today down towards 1.5. So very clear that the Fed over-tightened. They did have a quantitative tightening program alongside the rate hikes, and that drained a lot of momentum out of the economy. And it also made the yield curve a total mess. Now, the yield curve is something nobody pays attention to until it does something weird, and the current yield curve we have is doing something weird. Now, the yield curve is the interest rate level for a series of maturities between 1 month and 30 years. And clearly you can see by this chart, the rate on the 3-month is at 187, and the rate on the 10-year, at least at this time, was 155. That is an inverted yield curve. An inverted yield curve is a celebrated recessionary signal, but some say that pairing doesn't matter. What really matters is the 2-year and the 10-year, because the market sets those interest rates, and that curve is still positively sloped. So maybe we don't have a recession. Well, the Fed pays more attention to the 3-month, 10-year curve, and in fact, based upon their own calculations, if you look at the inversion of that curve over time, it has been an accurate predictor of recessions. And according to the New York Fed, there's a 30% chance that we'll see recession within the next 12 months. 30% doesn't sound like a lot, but if you go back and look at history, that's about the level where their forecasts tend to come true. So the bear is clearly at play in terms of monetary policy. Sadly, concurrently, the bear is also in play when it comes to fiscal policy. Before I start talking about the trade war, and I think it matters more than reported, it's important to understand why it is my push me pull you seems to be wrapped in a Chinese-y looking blanket. And that's to remind myself and all the viewers that what really matters is China's economic growth rate, and here's why. I broke down here the real GDP growth contribution of major regions around the planet. And you can see for 2019, China is basically responsible for 40% of all of the economic growth on the planet that we will see. Now, I also highlighted the other emerging markets in a lighter shade of red because they basically act like vendors into China. That's another 40%. So about 80% of it is the interplay between China and the other emerging markets. The US, which is the largest economy on the planet, isn't growing nearly as quickly as China, and therefore our contribution to growth really only amounts to 11%. And then for the remainder, you can throw in, Europe, you can throw in Japan, you can throw in Australia, but clearly global growth is a function of Chinese growth. And that's important to understand, and that's why our push me, pull you is Chinesey. All right, so the trade war. The global economy is really like $100 trillion, right? So when we started, tit for tat tariffs around 35 billion, even up to 50 billion with China, there wasn't that much global economic drag. It was an irritant for sure, and it had psychological impact, but there really wasn't huge economic impact. Well, that changed back in September of 2018 while the Fed was raising rates and trimming their balance sheet. When we layered in $200 billion worth of tariffs at 10%, China retaliated, recognized that we import a whole lot more from China than China imports from us. And so they don't have the same ability to go step for step with us as we ratchet up, which can be seen because we ratcheted up. So in May, we took the tariff rate to 25% on 250 billion, and now we're going to basically tariff everything, or at least that was the announcement, that we import from China, anywhere from 25% to 10%, unless, you're Donald Trump and you have a conversation with Tim Cook at Apple and it doesn't seem right that cell phones get a tariff on them. So now we're picking and choosing which markets or products that we import we end up putting tariffs on. I'm not sure how all of that will work. Nonetheless, what it means is there's a whole lot of drag in the economic system because fiscal stimulus is tax cuts, fiscal constraint is tax increases, and tariffs are tax increases. Well, the impacts on the global economy have been pretty dramatic. If you look at world merchandise trade volumes, they've basically collapsed while this trade war has escalated. The other way to look at it is, what are manufacturers doing? Are they seeing more orders this month than they were seeing last month? The answer to that is absolutely not. They're seeing fewer orders this month than they were last month. So the new orders index is really right now at a 7-year low. And we'll get some more data on that within the coming days, which could confirm this trend. Hopefully it hasn't continued. I suspect that it has. And because we're seeing this decline in world trade, because we're seeing this decline in manufacturing activity, it would stand to reason that those who are charged with forecasting global economic growth rates would be lowering their expectations as well. So what I'm showing you here is the path of forecasts for the Chinese economy from the IMF. And as you can see, in 2020, they've downgraded, they did it in July, their forecast for Chinese economic growth to 6%, which is a long way from the 6.6% in 2018 prior to the ratcheting up of the tariffs. And so what's bad for China, again, is bad for the world economy. And so what's happening to the United States of America is the exact same thing. So we've gone from a 2.9% growth rate in 2018, thank you tax cuts, to a 1.9% growth rate in 2020. Not thank you, I was going to say something rude, but not thank you tariff hikes. So we had a 33% drawdown in economic growth rates basically during the course of the trade war. And the other thing to recognize is there are a whole lot of people that are caught in the crossfire between the US and China. And those other countries trying to figure out how to navigate this environment have been cutting their interest rates significantly. In fact, the percentage of central banks on the planet cutting interest rates is as high today as it was during the great financial crisis back in 2008. So the bear clearly has an advantage given the fact that we've got monetary constraint policies in place and we have fiscal constraint policies in play. Advantage bear. But wait a second, it's not over yet. We've still got an opportunity for the bull to pull us or push us up a little bit. And so how are we going to do that? Well, it's time for the Fed to backtrack on their tightening And so the U.S. Federal Reserve cut rates on July 31st for the first time since the Great Recession. And they cut rates 0.25% down to 2.25. Jerome Powell came to the microphone. He's bad at it, but he came to the microphone and he said, we're thinking this is essentially a mid-cycle adjustment to policy. So basically, we're not on the edge of a recession. This is just a little bit of a weakening in inflation expectations, so we're just going to make some minor adjustments. Well, if he's right, that would be super bullish for the markets. So this is a chart that I pulled between 1984, best year ever. Email me if you want to know why after. But 1984 to 2002. And you can see that there were three occurrences during this period where the Fed actually did cut rates. They did do a mid-cycle adjustment and then went on to raise rates later before a more dramatic downturn. And each time they did it, in 1987, we had Black Monday. The Fed stepped in, they cut rates. By the time they raised them again, the S&P had gone up 7%. In 1994, there was a little bit of a deflation scare. Things were softening a little bit. And so the Fed cut rates and the market went up 40% or so before they raised them again. And then lastly, in 1998, we had the Asian currency crisis, which led to the collapse of the ruble, which led to the collapse of long-term capital management in Manhattan. And so Greenspan, the midnight hour, swooped in, cut rates, and the market went up 20% plus. So if Powell's right, and this is just a mid-cycle adjustment, then this would be super bullish for the markets. But the markets aren't quite sure that this is a mid-cycle adjustment. In fact, the markets are forecasting the Fed may have to cut rates 3 times between now and the end of the year. That would be less of a mid-cycle adjustment and more like an end-cycle adjustment. So that's what we have to determine from here. All right, so given all of the tugs and pulls and conflicts between the bull and the bear at this specific moment in time, which way will this fantastic beast end up going? One way to try and determine, and I think the right way at this particular moment in time, is to dig into the index of leading economic indicators. This chart takes it back all the way to 2000, and you can see basically since the Great Recession in 2009, this index has been positive, which indicates economic growth, but there have been moments where we've gotten close to the zero bound. In 2012, we got close to the zero bound, and guess what? We got a ton of stimulus out of the Fed. We did QE3. They printed a bunch of money. They bought a bunch of securities, and that helped revive stock markets and the economy. In 2016, we got back close to the zero bound, and guess what? Americans decided to elect Donald Trump. He cut corporate taxes. That revived the economy, that revived the markets, and we powered forward. Now we've got this restrictive monetary policy, we've got this restrictive fiscal policy, and we're revisiting the zero bound. So the big question in my head right now is, can we bounce off that zero bound, or are we going to collapse below it, which would be a very negative indicator for the markets and the economy? Well, to try and forecast the forecast, we have to dig inside of it and take apart some of the components and figure out where the momentum lies. So the largest component actually within the leading economic index is the average weekly hours worked for manufacturing employees. And this is almost 30% of the index. And it makes sense that this would be a leading indicator, but because before companies fire people, they tend to reduce their hours, right? Well, right now we are seeing a reduction in hours within manufacturing, which correlates with what we saw earlier, new orders falling, not having to put as much into production. You probably reduce the hours for the people that are working for you. That correlates again with an economy that's perhaps being challenged right now by this policy array. The second highest weighting within the leading economic index is the manufacturing ISM new orders that we revisited from before. Are we getting more orders or less orders than we got last month? This is a 16% weighting in the index. As I've shown you, it's been decelerating. It's down at the 50 line. There was a slight uptick back in July. Whether that holds or not, I'm not really sure, but the trend at this moment is definitely lower. Consumer confidence makes up the third largest weighting within the index at about 14%. And I have sort of a mixed read on consumer confidence. It's very high, which is great, but it's also at record levels, which means the path of least resistance is probably lower. And in fact, we have seen a little bit of a downtick in consumer confidence as trade frictions and market declines have unnerved even the most stalwart of shoppers. My daughter doesn't seem to be deterred by this, but when we get to that level, it's recession for sure. All right, now the last component I'm going to sort of dig into, and there are 10 of them, but the one that has enough weight to be discussed would be the 10-year Treasury minus the 3-month Treasury. Again, the inversion of the yield curve that we talked earlier. Fed pays attention to this. It's easy for the Fed to uninvert the yield curve. All they have to do is cut interest rates down to a level below the 10-year. So in the last Fed interest rate cut, that was kind of their motivation, I think. Here was the problem. So it's an 11% weighting in the LEI index. It fell below 0 in May, which triggered some anxiety. The Fed then cut in July, and when they cut, the 3-month went down, the 10-year went up a little bit, and it almost uninverted, I should say. But here's the problem. The next day, Trump tweeted out that we were going to put 10% tariffs on everything Chinese, and the curve inverted even further on the fears of a renewed, if not expanded, economic slowdown. And so if the Fed and Trump and the other monetary authorities and fiscal authorities on the planet can keep this index from sliding beneath 0, it's a very bullish indicator for the markets. So back in 2012, when the Fed layered in QE3, the S&P rallied 30%. Back in 2017, when Trump passed the Jobs Cut or Tax Cut and Jobs Act, the S&P went up 40%. So we can rally from here, but I will say it's going to require significant fiscal stimulus to be able to get that line moving in a positive direction. Now, what kind of fiscal stimulus could we possibly get? Well, what if we get a trade resolution? I'm borrowing this information. This analysis was done by Oxford Economics, but I basically agreed with it, so I didn't have to do the math on my own. What I'm going to show you is the impact based upon their modeling of what policy stimulus plus trade resolutions would do to world GDP and world trade levels. First of all, let's go through some sequencing. Let's say that China loosens monetary and fiscal policies. Well, just 2 days ago, China lowered their prime interest rate, which are loans to small businesses. That is very positive for the Chinese economy. And on the fiscal side, it's harder to get a handle on it. But remember, they run a directed economy. And if they want to build more bridges to Macau, they can do it. And that's always stimulus. And so the Chinese have started stimulating to try and offset some of the drag from the trade tensions. Global central banks maintain or increase monetary stimulus. That is happening. As I showed you, banks have been cutting rates at a speed and a percentage that they haven't done since 2008. We're now involved in that as well. And so central banks are cutting rates globally. Here's the kicker. What if all current protectionist policies expire? Trade war ceases and it's free trade for everyone. Doesn't that sound awesome? In that environment, the US dollar would decline. The tensions on the planet and the disruption in interest rates has made global capital flow into the United States. When it flows into the United States, the dollar goes up, which irritates Trump, it irritates corporations, and it creates havoc among offshore borrowers who are borrowing in US dollars. And so it's very disruptive for the dollar to be high. In fact, the dollar last night touched a level it hadn't seen since 2001. So we're back towards record highs, at least on the dollar. Pressure relief there would certainly be good for investors overseas and good for the global economy. And it of course means that commodities would rally since they're priced in dollars, and the emerging markets would likely rally sharply. They're very cheap if you look at them from a PE perspective or price to book or whatever measure you want to use. Problem is nobody wants to own them in the middle of a trade war. End of trade war, initiation of emerging markets rally. So if you got policy stimulus and resolution, what could markets do? I think you could see equity markets rise 15 or 20% in celebration of the all clear. Yeah, but what if it's a continued trade war that escalates and becomes full-blown? This is the R-rated version of this presentation. That would not be good. So if the US and China apply a 35% tariff on everything, and let's say we apply a 25% auto tariff on Europe, blah, 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 tariffs for everyone, you can see that would dramatically decrease world GDP and trade volumes. The US dollar would appreciate, which is what happens now, and that would magnify the losses overseas that I described on the previous slide. Productivity would fall in emerging markets. This is important. I think, and I've got the data to support it, the world was globalizing, which I know has become sort of a toxic political term, but the world was globalizing up until about the financial crisis. And what that meant was we were bringing emerging market economies online. Here's why that's so important. So in the US, the per capita GDP levels, and this isn't precise, are about 50 grand, call it 55 grand. That's what each of us sort of have as a share of the economy. In the emerging markets, it's 5 grand, it's 10 grand. We have 300 million people here. China has 1.4, 1.5 billion people. If you take 10 grand and you multiply it by 1.5, but then you escalate it to 50 grand and you multiply it by 1.5, then you got a whole lot more economy for China, you got a whole lot more economy for the rest of us, good for corporations, et cetera. So to maximize the economic potential of the planet, we need to online these lesser developed economies. Well, if you deglobalize, if you stop doing international trade and you start balkanizing, then the productivity levels are going to fall and you're basically going to retard the development of these developing economies, which we need to help grow our own. So it's kind of a long explanation, but it's really important. We've shifted from globalizing to deglobalizing, and deglobalizing is bad for economic growth over a long period of time, and bad really for the reduction of poverty on the planet worldwide. In this environment, we would likely see the equity market sell off 25 to 30%. You get into a serious trade war, you balkanize, trade collapses, manufacturing collapses, work hours collapse, you can see the cascade. All of that would end up hurting corporate profitability and equity markets would have to adjust. So, full-blown trade war, bad. But there's a central lining. Central banks would be forced to reinstate emergency monetary policies, and perhaps, going back to 2009, you could set off a long-term rally. Furthermore, we have to consider what the probability of this is and know that this changes all the time, right? So this is a chart. Of course, Goldman Sachs created an index because you can sell indexes, but they created an index that tracks the implied probability of a trade resolution. I'm not going to take you through each one of these colored nodes, but just know this. Red means tariffs, green means delay in tariffs. The last point of interest was Trump announcing a 10% tariff on 300 in Chinese goods, or 300 billion in Chinese goods, and that would happen on September 1st. And then a couple days later, he said, well, maybe not on cell phones and stuff. Nonetheless, it doesn't look good from Goldman Sachs's perspective. Take their perspective with a grain of salt, but their probability model says maybe there's a 12% chance this gets resolved. I'm a little more optimistic than that, and here's why. I think Trump's negotiation motivation might be his personal interest in being reelected president of the United States. Within the past 3 weeks, we did see a downtick in Trump's approval rating after he levied the 10% or threatened to levy a 10% tariff on 300 billion in Chinese goods. And so once the voter starts voting against trade wars, then that's a vote against Donald Trump. My guess is the reason that he delayed for the shopping season, toys and cell phones and some of those other items that were on the list, was to try and revive a little bit of voter enthusiasm for his policies. Here's the other thing I know. Presidents do have power, and when they're in power, they want to maintain that power, which means you got to get into the second term. If we go back and look at the rates of return per year of a first-term president, you can see year 1, not that great. Year 2, they're trying to get policies passed. Hey, year 3, starting to think about re-election. So historically, in year 3 of a first-term president, markets go up 19, 20%. By the way, that happened before this recent downturn. And that carries into year 4, which is the actual election year, maybe a 12% rate of return over a long period of time. Now, history is not going to repeat, but it does sort of rhyme. If you're a president and you're interested in being reelected, you might consider adding some fiscal stimulus rather than fiscal restraint. And oh yeah, I saw on my Twitter feed last night that Trump is considering cutting the payroll tax, right? So there may be some stimulus offsets out there because I assure you, Donald Trump wants to be reelected. All right, so here's the balance. You may have already jumped to your conclusion, but I'll take you to ours. On the push you down side, we do have, in my judgment, restrictive global monetary policy, specifically because the US Fed is too tight. But on the pull you up side, central banks all over the planet are cutting rates, including ours. I would cut 50 basis points, 0.5%, if I were Jerome Powell, but they seem locked into this new reality where they only move 0.25% and they broadcast it 9 months in advance. We'll see if he can get a little bit more maestro-like, but for the moment, I think we're tight, everybody else is getting loose. Fiscal policy in the United States is restrictive. Yes, we're running a deficit, and we're running a deficit of 4 or 5%, so there's plenty of spending coming from the government. However, taxes are bearish. And so, yes, you cut corporate taxes, things go up. You raise tariffs, things go down. So I think the fiscal policy in the U.S. overall is restrictive. But the governments are considering adding fiscal stimulus to the system to try and counterbalance what's happening on the bearish side. So even Germany doesn't like to spend money, is considering doing some stimulus. And like I said, Trump is tweeting me in the middle of the night talking about potential further tax cuts. That sounds great. Not sure he can get them passed. Don't know how big an impact they'd have. Wait and see. Because we've got on the bearish side, global monetary policy restrictive, and we've got fiscal policy restrictive, we have, as I showed you, falling trade levels, falling manufacturing levels, falling capital expenditure levels. Do you really want to invest in a factory right now when your orders are declining? The answer is no. So we've seen a decline in capital expenditures. Falling corporate profit estimates. Profits shrank in the second quarter. They'll likely shrink in the third quarter. Fourth quarter estimates, I think, are too high, need to come down. And then as contrary indicators, you got very low unemployment levels. If you think back to that chart, they don't tend to stay at those ultra low levels very long. You also have very high consumer sentiment levels, hard to punch higher from there, and profit margins are looking a little toppy. Certainly we have a lot of clients who are in business and they've been impacted by what's going on with the tariffs, and their profit margins are definitely at issue there. So that's what's happening with all that restrictive policy. But because of that, economic growth rates are coming down, long-term interest rates are falling globally, so there are some cost savings on interest payments to help offset, not enough, but to help offset. And the leading economic indicators are deteriorating. We've walked through that. We will get a report. I'm not sure when you'll see this, but we get the July report on August 22nd. That's a big number. Real excited about that release. And we'll see if we get above that zero line or if we tip below it. I would imagine the market would react pretty significantly if we tip below. If we tip above, maybe the algorithms give us a rally. We'll see. Stock valuations are very low relative to bonds. So there is support. You know, the 10-year Treasury at 1.5% yields less than the dividend yield of the S&P 500. So there's support beneath stock prices because bond yields have gotten so low, makes stocks more attractive. And presidents really do like to get reelected. And I think Donald Trump would like to get reelected. And so we might get some sort of cosmetic deal with China that allows China to save face and allows the president to get reelected. For those of you who like a conspiracy theory, there are two people on the planet who can make it so that Donald Trump is not president again. Number one, Jerome Powell, who runs the Fed, and they don't seem to like each other even though Trump hired him. And two is Xi Jinping that runs China. So if you really don't like Trump, don't do a trade deal. If you really don't like Trump, don't cut interest rates. So I don't know what the interplay is between these masters of the universe, but those are the two people in my judgment that really have the greatest vote. And then, of course, one thing we've all come to recognize is that one tweet can change everything. So if we do get a tax cut, if we do get a trade deal, if the influence on the Fed through Twitter ends up changing policy direction, more dramatic rate cuts, he called for 1% the other day through Twitter, that could goose things significantly. Or he could say, let's go to 35% tariffs. The Chinese aren't doing what we want them to do. So one tweet can sort of change the world. Now, this drawdown that we've seen recently could be just another bear within a bull. You may recall at the end of last year, we did a lot of analysis on what was a very dramatic drawdown in the fourth quarter and basically said, don't worry about it. It's going to be fine. Things are going to recover. And they did. So I'm very happy that that forecast paid dividends for all of us. But here we are back at those new highs. Could be another correction within a bull, but it could be something more. So this is a chart that shows you the dates of the official recessions going back to 1950. This is the size and duration of the bear market drawdowns in recessionary periods, and they do tend to be larger. We, in the era of modern central banking, have been able to extend what used to be 4-year economic cycles out to about 10 years. But in doing that, we create maybe a little bit more need for the forest fire to take valuations down, to reset the economy, etc. So recessionary bear markets tend to be down more than 25%, which is what I'm showing here. Corrections within economic advances aren't normally down more than 15. So knowing all of this, I want to remind you at Waddell & Associates that we do manage risk, and we think a lot about risk. So I'm going to walk you a little bit through, in a simplistic way, what's going on within our investment committee right now, some adjustments that we're making. First of all, I will remind you that of our 100% allocation to global equities, 80% are in strategies that are enhanced index and factor-based and qualitative, basically active and passive strategies. Our ambition there is to track or exceed our benchmark index, which is not the S&P 500, by the way. We're global investors. It's the MSCI All Country World Index. So that's 80% of it. 20% of the portfolio we reserved in the portfolio design as a risk dial. If we get very bullish, if it's early in the cycle, we can take on a whole lot more risk and hopefully earn more return. If we get a little bit bearish late in the cycle, we can dial down the risk to help protect our hard-earned gains. In the current environment, based upon the balance of risk-reward I just walked you through, we've decided to hedge out 20% of our global equity exposure. Now, we don't hedge often, and I don't think you should. I think trying to time markets is a loser's game. However, recessions are periods with enough of dramatic movements that it makes sense to try and hedge out some of the downside risk. Makes no sense to try and time a market that goes down 10 to 15% because you're going to be wrong on the sale, you're going to be wrong on the buy, and so you don't have much to work with. But in a recessionary bear market where you got 25 to 30% drawdowns, potential drawdowns, not saying I'm committed to that, cautious, nervous, but not fully committed to that, you've got plenty of dispersion in returns to be able to be wrong on the first 5%, wrong on the second 5%, and still be able to insulate the portfolio significantly from the downside. So we haven't hedged since 2007. We are doing it now. We are doing it because if you go back and consider the math, I think max upside is 15 to 20%. I think max downside is 25 to 30%, and that puts the balance on the bear rather than on the bull. And so let's hedge out some of our market exposure. This is not a fully hedged position, by the way the math works, and I won't get too technical on it. The way we've designed the portfolio, we can hedge out 40% of risk. And by the way, we can do this very quickly with very low taxable consequence and very efficiently. So this is the posture that we are currently in today. And remember, it's a core value of our company that our employee assets are invested in the same investment strategies as our clients, that we practice the same financial planning principles that we recommend for our clients. And at this point, it makes sense for all of us, since we're all in the same boat at Waddell & Associates, to take some of this risk off the table and to hedge. So in sum, going back to our mythical beast, which direction should we be facing? I think we sit facing the head of the bear. Now, again, this isn't a dire prediction. It's just an environment where I feel like it makes some sense for ourselves and for you as well to take risk off the table until we get a little bit more clarity on where all these trade frictions are going and to what degree the central bank will be able to stimulate this economy. So it's a huge honor and a huge responsibility to be the stewards of your hard-earned capital. I feel good about the decision. I'd be happy to talk to you about it further. You know how to contact me or contact any of us at Waddell & Associates because, again, we're all in it together. High conviction, change perhaps in the cycle, have adjusted the strategy, and will adjust again if conditions change. Thank you very much for taking the time to review this outlook with us. And again, let me know if we can help in any way.